Good morning, everyone. My name is Sahib Singh Chadda. I am the moderator for this session, along with Mr. NPS Chawla, Associate Partner, Vaish Associates. This webinar is conducted in association with the Merchant Chambers of Commerce and Industry. We welcome you to this webinar on corporate restructuring, a Panacea for corporate turbulence. To take us through this interesting webinar, we have with us Mr. Ajay Vora, Senior Advocate, Mr. Satwinder Singh and Mr. Rohit Jain, Partner, Vaish Associates, and Ms. Mamta Minani, Chairperson, Legal Affairs Committee, MCCI. Ms. Minani is a practicing advocate and is an insolvency professional. It happens to be that she was the first insolvency professional registered with the IPVI. Ms. Minani has over 25 years of experience and has also been conferred with Bharat Nirman Award for Excellence in Professional Services. Ms. Minani is also a fellow member of the Institute of Company Secretaries of India and was also the past president of ICSI. Before I hand it over to Ms. Minani for her address, I would request all the attendees to please put in your questions in the questions tab, and we'll be taking up such questions at the end of our discussions. I hope all of you will have some key takeaways from this session. Thank you very much. Over to you, Ms. Minani.
Thank you so much, Sahib. It's such a pleasure to be in this foreground, if I may say so, and having a program on corporate restructuring. Because going forward, as the pandemic unfolds itself, I think corporate restructuring would be the norm of the day, and it is only this probably who would bring the rescue to the corporate visionaries as to how to move forward. Before we really delve into the subject, I would like to thank on behalf of the Merchant Chamber of Commerce and Industry, which is one of the leading and forerunning chambers, not only in Calcutta, but in the entire eastern part of this nation. I would like to thank on behalf of the entire managing committee and the president to Vaish Associates and specifically to Mr. Satwinder Singh ji, with whom I was actually discussing for a long time as to what value addition should we bring to the chamber participants and of course to the industry at large and the professional community as to what should be the medicine to come out. I know we cannot prepare a vaccine as a doctor, but yes, we are corporate doctors, and so maybe this corporate restructuring program which we are trying to unfold in front of you would bring much needed vaccine to the corporate restructuring arena. Let me just tell you in the beginning as to what this chamber is all about. And then, of course, I would like to extend my gratitude to Mr. Rohit Jain, a very senior partner, Mr. Ajay Vora, who's a stalwart in himself. We read so many judgments of yours, Ajay sir. It's such a pleasure that you are here with us. And of course, Mr. Chawla, NPS Chawla, none other than our Central Council member for the Institute of Company Secretaries of India, and the Sahib. I am tempted to just mention about NPS before I get into what MCCI is all about. NPS is a very dear brother to me. Satwinder Singh ji is an elder brother to me, and NPS is the current Central Council member of ICSI. He's been the chairman of the Northern India Regional Council for the year 2015. And when you really listen to him, you will find how MCCI started its journey in the year 1901. Yes, friends, you're hearing it right. It's 1901. So it's been long number of years that we are treading this country. This chamber was very keen. I'm very keen to mention this, that this chamber had plunged into the Swadeshi movement in the year 1921, which was led by Mahatma Gandhi. So this chamber actually was born when the national upsurge was quite high. As I said, it was 1901. And since then, this chamber has been working very hard to see that the homegrown industries are actually looked after well, and all the policy issues are taken to the right table of the government and the regulatory bodies. So this chamber has been working pretty hard in that front, and a lot of MSMEs and big industries are a part of it. You name any industry honcho in the eastern part of the country, and you will find their main person, the chairman or the managing director or the main promoter, either as a past president of the chamber or as the trustee of the chamber. So this is how the chamber is taking big strides to bring a lot of wisdom to its members and also to the industrialists otherwise. Sahib, I hand it over to you, and I think let let our professional friends and industrialists who are watching this program know that there are quite a lot of key takeaways from this program and they should remain with us till the end of it. Thank you so much for this opportunity, Sahib.
Thank you, Mamta ma'am, for first of all for such a nice introduction which you gave about all of us and also about MCCI. In fact, we must thank you for agreeing to host this event. And MCCI, I have been earlier also invited in Kolkata for speaking for that chamber. So friends, I also welcome you all along with Sahib for our today's webinar, Corporate Restructuring, Panacea for Corporate Turbulence. In fact, this theme was coined by Satvinder sir many years back, if I'm right, for NIRC event. And then thereafter we did many events, but somehow I realized when we were doing our recent webinar on clean slate theory with Mr. Bomi Darwala and Mr. Bora, there on the same day I got a call from a client that he has 2 units. In fact, Satvinder sir would be sharing this case study later. He has 2 units, one in Ludhiana and another in Odisha. The Ludhiana unit has 1,000 employees staying inside the campus, the workers, and the Odisha unit otherwise also was not doing well, and that's like shutting down or would be certainly incurring loss. But both the units are in one company. So he called me up, what to do NPS. Now you tell us corporate restructuring. Now you explain us practically how will you do it. So I explained him 3-4 options which he has, 3-4 modes: slump sale, demerger, acquisition, whatever. And then he said, यार तू बता करना क्या है, ये बहुत सारा बता दिया. And then at that moment I remembered our founder Mr. O.P. Vaish. He always used to say that we need to keep the objective in mind. So objective of every restructuring must be kept at mind, at the back of mind, while we do the structuring. So friends, for this webinar for the next 2 hours, you can certainly expect a lot of nuances to be shared. Nuances particularly with regard to the compromise arrangement. There is one thing which is very, very bothering these days. Many professionals, many IPs, many corporate debtor, many business entities is one that section 7, 9, 10, there's a talk that it may get suspended, IBC provisions would be suspended. But at the same time, people are wondering how to then do the resolution. So is there a resolution possible outside IBC? The answer is yes. So we would be sharing as to how one can restructure the creditors, restructure the debt already existing in the books, and what would be the implication. So every restructuring, honestly, I feel is driven by some benefit. May it be tax benefit, and most of the time it will be driven by tax benefits, and it will be tax planning which we do. And so that way we'll also be sharing, and we have 2 eminent tax experts, Mr. Rohit Jain and Mr. Ajay Vora, who will be sharing their valuable experience with us on how one can do the corporate restructuring, particularly in this time. And I'm sure there'll be many questions asked to us on waiving off of the loans which are existing and waiver of the loans. At the same time, slump sale is possible. What would be the implications? Hiving off of one loss-making entity. At the same time, in fact, Sahib was discussing with me a couple of days back the possibility of reduction of capital by setting off of the losses along with the reserves. So that way, friends, I'm sure in the next 2 hours, you will have a lot of takeaways with you, a lot of nuances, practical matters which we have handled. You will be able to gain experience, and you can certainly ask. We have already received many questions which we will be asking at the end. And for doing the discussion, we have eminent panelists with us. So first of all, Satvinder ji would be starting. Mr. Satvinder Singh, who is a commerce and a law graduate. He is also a fellow member of the Institute of Company Secretaries. He was former Central Council member, and he was also chairman of NIRC. And presently, he is also the chairman of Secretarial Standard Board. In fact, I would not be doing justice if I don't tell you that this subject, and if I don't introduce Satvinder ji like by telling you that this subject has actually gone in his blood. So he must have done by now, if not less, more than 250 schemes by himself. So he's an all-rounder. He drafts the scheme, he drafts the resolution plans. He's an insolvency professional also. In fact, Sahib referred that our dear Mamta ma'am is the first insolvency professional of the country. Coincidentally, Satvinder ji is the second insolvency professional of the country. Both were registered on 1st of December 2016. I still remember. And in fact, Mamta ma'am also has to her credit the benefit and the unique speciality of getting the first resolution plan also sanctioned. And that's how Satvinder ji would be sharing his practical experience. He is very ingenious. Let me tell you, in the meeting itself, he'll tell you some structure which we later on think, sir, kahan se bata diya aapne ye structure? So Satvinder ji would be sharing his experience on corporate structuring, the compromise arrangements, the legal aspect of it. But let me tell you, friends, no corporate restructuring is possible unless we discuss the tax impact of it. And for that, we have with us our senior tax partner, Mr. of experience. He looks very young, but I checked with him, sir, pakka 20 saal ho gaye. You are so young. You look younger than equivalent to Sahib and younger than me, certainly, by your looks. And Rohit sir is a familiar, very familiar face in High Court and ITAT, oftenly appears there. I personally call Rohit sir as the senior counsel's counsel. So I don't know whether I should share or not, but I'm sharing that Rohit sir is appearing and handling personal tax matters for all legal luminaries, many legal luminaries. Many senior counsels, discuss their matters with him for the income tax matters. So Rohit sir, we look forward for your views on income tax nuances and income tax implications. So friends, one, we have Satvinder ji, who is corporate expert, then Rohit sir, who will be sharing his tax inputs. But so then we need some senior counsel to lead all of us. The entire panel discussion need to be navigated. That's how we requested our own Mr. Ajay Vora, who is a senior advocate, and before being designated as a senior advocate, he was managing partner of Vaish Associates. Mr. Vora is also a chartered accountant. So in fact, we have two company secretaries in the panel discussion and two chartered accountants. And I remember when I joined the firm, I used to ask Satvinder ji. In fact, I asked him once that, Satvinder sir, are you a chartered accountant? He said, nahi, log yahi samajhte hain, samajhne de, koi nahi. Although he is not, but the tax provisions are so clear to him. The kind of discussions for the last 3-4 days we were having with Mr. Vora, with Mr. Rohit Jain, with Ms. Mamta ma'am. I was again thinking that Satvinder sir is a chartered accountant, but Mr. Vora certainly has to his credit leading many judgments, leading many matters where landmark judgments have been delivered, and he is considered as one of the most reliable senior counsels for tax matters and commercial matters. My relationship with Mr. Vora is very sweet. I remember I briefed him some matter 10 years back, and couple of months back, 1 month before this lockdown, I was briefing him for a reverse merger matter. Friends, very interesting. So reverse merger, as you know, is allowed, is permissible. But somehow we got to know when we were doing one scheme recently that income tax department has an internal circular that the standing counsel will have to object to every reverse merger because they know why it is done. And then we requested Mr. Vora to argue this matter in NCLT. We got the scheme approved. Mr. Vora, during the course of the arguments, called me, NPS यार एक judgment तूने मेरे को उस matter में 10 साल पहले, 10 years back, he said you briefed me, you take out that judgment. I was wondering. So that's how we call Mr. Vora as a photographic memory, and the kind of inputs which he give is always always a blessing for all of us. And Mamta ma'am, already a lot of things have been said, and she's a brilliant orator. We all look forward to listen from you. So friends, for the next 2 hours, now we'll be having a lot of discussion about it. Satvinder ji, I request you to please navigate it from here.
Thank you, NPS. I think you have set the tone very rightly, and you mentioned that in 2007 at the ICSI when I was a chairman, and we coined this. But before this, I think I coined this term when I wrote one article and put it that corporate restructuring is a panacea for corporate turbulence. And then I suddenly was realizing that how this the coin term is so much relevant, becoming relevant when we all are talking about that the IBC, we are talking about the suspension of IBC and the resolution, and how best we can, take the benefit of the provisions of the Companies Act or the RBI circular, which the resolution which we can take it outside the IBC. But I think before I dwell upon this subject, it is very important that, let me take you a little bit on this thing is the provisions of the Companies Act. Now we had the section 391, 394, now which is at par like section 230 to section 232. Now that from section 230 to 240, it is under part 15 of the Companies Act 2013. No, I was just looking at it is, if you look at the heading, it talks about The compromise talks about the arrangement, amalgamation, and then earlier it was the reconstruction. Now, if I ask Sahib, if I ask you that what compromise presupposes, then what is your view? That what compromise presupposes, Sahib?
Compromise presupposes a dispute.
So it eventually presupposes that there is a dispute. Believe me, friends, I'm just making it as I'm telling you is, even if there is a dispute between the company and its shareholders, even if there is a dispute between the company and its creditors, and you are not able to get answer under any other provisions of the Companies Act, this section 230 to 232, which we normally say it's a complete code in itself, single window, it comes to your rescue. You draft a scheme, get it approved with the requisite majority of the shareholders and creditors, and once this scheme is approved with the requisite majority of the shareholders and creditors, it becomes binding even on the dissenting shareholders and the dissenting creditors. Now, I was just reading it that how one can view the binding effect of that scheme. And I at that time also, long time back, I catch hold the aspect of, there was a 1917 judgment of the Supreme Court in the case of S.K. Gupta. And it was very, I just noted this thing that before the court sanctioned the scheme, it partakes the character of an emerging character between the company and creditors and the members. And once the court approve it, it becomes a statutorily enforceable contract even on the descendants. So eventually, once that scheme is there, it will partake the color as a contract between the shareholders and the creditors. And once it is approved with the requisite majority of the shareholders and creditors, it is even binding on the dissenting shareholders and creditors. But take a pause. I just want to deal on that aspect. Sometime when we draft a scheme, it comes that, okay, whether the leased property, can it be automatically transferred to the transferee company or to the amalgamated company? Can there be, or you need a consent, because that's a third party is involved. No, neither they are shareholders or creditors. And the Supreme Court in that Radio Journal Appliances said that no, that you have to take that approval of the landlord if you are transferring the leases to the company, so that it's not that a binding effect. Like I'll give you another example. You see, we handled it. Where the people come that, okay, why not? I just want to demerge my business, right? And I just want that, okay, in the process of demerger, since I am into the tenders, contracts with the various government authorities and all, I just want that, okay, my pre-qualification criteria, which I'm enjoying in this company, just by demerging one of that unit, I should take it to the resulting company. Now, the question comes whether it would be binding on the contractees or not. That would be a question. I think that, okay, that would also be litigated. It can have a persuasive value. But if you take it to the third party, the third party may dispute it. So one has, even if you have to take it, I think it is very, very important that how you have to build a scheme, how you have to put it. I'm not saying for this thing, or you have to put them into notice and all, so that to that extent, how we can make it as a contracting value. So that is where it is coming. Now the question comes is that how far the provisions of section 230 are relevant in the current context when we are saying that there is a COVID-19, particularly there are losses. We are talking about the restructuring our operations. Out of that, how we can take it. Now, before I touch upon section 230, but I'm just making it is, I'll just make a brief mention. We had the corporate debt restructuring. We had the SDR, that's a strategic debt restructuring. We had the S4 norms, particularly for the stressed assets, which are governed under the RBI mechanism. Now, what happened in the February 2018, when RBI issued a new circular, new guidelines for the stressed assets, so they wound up all those schemes, all that framework, and they say that would not be applicable. No, but unfortunately, that February 2018 circular was challenged before the Supreme Court, that you cannot make a general observation that, okay, you can take every company under the IBC for this. So in April 2019, that circular was struck off. Now then RBI has tweaked, the basics remain the same, but they tweaked this that, okay, it is not that, okay, you have to mandatorily take IBC, but they have given the guidelines that how you can take the mechanism. And there is a process for the resolution under the June 7 circular by the RBI. You can take it. There is a concept of a review period. You have to go for an intercreditors agreement. Then there is a 180 days they have given. It's like a moratorium that you can implement it. But there is no time limit for that implementation. What they are saying is, if it is not implemented within a period of 180 days, they have provided a prudential norms that, okay, you have to increase the provisioning for this. So one is that I can look at the RBI June 7 circular, where I would say that I can take the benefit by the restructuring by the lenders, where they will just make it, they will tweak it and other thing. But earlier in February, they made a precondition that it has to be 100% approved by the lenders. It was objected to. But then what happened? Then they said that no, it is not required 100%. What you do is, if you have the consent of the lenders, which is 75%, and the lenders, they have defined it, those who are basically governed under the RBI mechanism, like the bankers, financial institutions, but it is not covering the ECB lenders, it is not covering the bondholders. So to that extent, what they were saying is that, okay, you can take resort of the RBI provision outside the IBC purview. Let us look at it. And they have also given a very wide concept on the restructuring. Even they lenders can think about the still. I think NPS was discussing on this issue where it is coming, and we can discuss it. And how outside the IBC we can take a result of the June 7 circular. But that is the one thing. But look at section 230. When 2013 came, though RBI has dispensed with the requirement of CDR, but under 230 they have already provided the provision of the corporate debt restructuring, where what you do is you have to give a creditor's responsibility certificate, you have to give the assets criteria, you have to see the valuation, you need to look at it, that how you will secure the interest of the unsecured creditors and the other secured creditors. But once that will be approved under the 230 mechanism, and you see, I'm doing one matter for this thing where one of the lenders was objecting to it, that, okay, no, I will take you to the IBC. Other two lenders are agreeing and amenable to this. So I thought that, okay, instead he's taking you to IBC, where you will have the implication of 29A, right? The concept where under the IBC is from debtors in control, it will move to this. Why not you yourself move an application under 230? Under the CDR, when two of this thing, I will have, so what is the requirement? That I need a majority, where under even the RBI circular, it is the 60% in numbers and 75% in value, total outstanding. Here under the CDR, where we are talking about is you take wherever with whom you are taking it, 75% consent of the secured lenders. But ultimately, if you have to pass that resolution with 75% of those who are present in person or proxy and the 50% criteria. So I was just looking at it is that how best we can take the provisions of 230 and maybe that, okay, we can make a combo. We can think about the resolution outside IBC by taking the June 7 circular combo with 230 and see that how best we can create a resolution for the companies which you are making it is. Apart from that, that is there. So where you can seek the waivers, you can talk about that, okay, I will get this much haircut. We have seen under that IBC, the haircut ranges from 30% to even it has gone above 90%. So that is where we are just looking at it is even where the IBC mechanism has not been taken care of, that, okay, that is being suspended. The corporates do have the other mechanism. It is that, okay, I'm not saying that everything has to go in a one way. It has to be on the basis of the facts and circumstances of each case, but one can structure that mechanism, one can structure that scheme. But I think in that aspect, wherever under the IBC I'm doing it, Rohit, I have that issue to you from the tax aspect. You see, when we go for a waiver of the loans from the lenders and other thing, it is always because every scheme look at it that it has to be tax efficient, as NPS was talking about. Now, when you talk about the waivers, so I have a different loans. I took a term loan. That's a one situation. I took a working capital loan. Certain times I have provided for the interest, but not debited to my P&L. Some interest I had provided in my P&L account. That once that waiver comes, what would be the tax impact if you can guide us
Yeah,
on that?
thank you, Satwinder sir. Uh, Compromise, as you explained, compromise has a very wide term, and in fact, it includes even debt restructuring. And when we talk of debt restructuring, the haircuts are the basic thing which basically happens when you enter into discussion with the lenders, and they agree upon the haircuts. Now, here comes the tax implications, and they can be very critical because if these haircuts are actually subjected to tax under the provisions of the act, then there is an outflow of resources because the 30% or 40% rate, if they were subjected to, that's an additional outflow which happens, and the haircuts loses its sanctity. Now, to answer your query, what are the tax implications of haircuts? I'll bifurcate into two parts. One is the implications under the normal provisions, and the second is the implications while computing the MAT provisions, which is the deemed income. Now, under the normal provisions, now, first of all, I'll discuss the normal provisions. Now, for normal provisions, we will have to first distinguish between the principal amount and the interest amount. As you said, there can be various kinds of loans. Loans may be term loans, they can be working capital loans, and various kinds of loans. And there will be two components. One will be the principal component and the interest component. The principal component, as we all know, is a balance sheet item. It is always there in the balance sheet. It never goes to the profit and loss account. Whereas the interest component is concerned, interest component either goes to the profit and loss account or is capitalized as cost of the asset, depending upon the purpose for which the loan is taken and depending upon the period for which the interest is being paid. Now, when the haircut happens, in case of a principal amount is concerned, now there has been an ongoing debate as to what happens insofar as the principal component is concerned, whether the write back of the principal component is or is not taxable under the provisions of the Income Tax Act. Now, the Income Tax Department would always say that when you are doing a business and you take a loan from any lender, that is part and parcel of your business activity, and therefore when a write back takes place of the loan liability, even the principal component, that is in the course of the business, and therefore any write back has to be treated as part of the business profits for the purpose of taxation. And for that purpose, they used to apply the provisions of section 28(4), which says that any benefit which is derived by an assessee in the course of its business, that will be subjected to tax as business income. Now, in that, so there was a dispute which was going on. The various courts were taking different view. In fact, the Delhi High Court in two of the judgments in Roletanas and Logitronics held that the nature of the write back or the taxability of the write back of the principal component would depend upon the usage of the loan. So they made a distinction. So they said that in the case the loan was used for the purpose of acquiring a capital asset, and then there is a waiver of the loan, wholly or partly, in that situation, the write back will not be subjected to tax under the provisions of the Act because that's a capital account transaction. Now, but they held that in case the loan is actually utilized, so it is not relevant whether the loan is a term loan or the working capital loan, but the loan is utilization was relevant according to the Delhi High Court. They said the loan was utilized for on revenue account purposes, for example, for stock in trade, etc. In that situation, the write back will have to be treated as a revenue account transaction and it will be subjected to tax. Now, there was another judgment of the Bombay High Court in the case of Mahindra, wherein a tooling for purchase of the toolings, there was a loan which was taken and it was taken with the permission of the RBI. The tools were capitalized by the Mahindra in its books of accounts, and the depreciation or the amortization was claimed in the return of income. Now that loan was waived off by the principal party because of the takeover of the entity which gave the loan, and the loan was waived. Now the issue which arose in the case of that Mahindra Bombay High Court was whether this write back of the principal amount of liability is or is not taxable under the provisions of the Act. The Bombay High Court held that Section 28(4) is not applicable for the reason because in that case it was on capital account and therefore it is not taxable. So the revenue went in appeal before the Supreme Court and all the cases were clubbed together. Mahindra's judgment, the Delhi High Court in Logitronics, Lowell Tenors, etc. all were clubbed together. The principle which the Supreme Court laid down in Mahindra was Section 28(4), which was normally applied by the Income Tax Department to tax these kinds of write back, was that Section 28(4) applies only to non-monetary transactions. Whereas when there is a waiver of a loan, it is a monetary transaction. Because why they say it is a monetary transaction? Because when you take a loan, the obligation is to repay the loan. And when you repay the loan, there is some monetary benefit which you get because now you are no longer required to repay that loan. So they said that this is a monetary transaction, whereas Section 28(4) is applicable only to non-monetary transactions, and therefore this cannot be applied. An alternative argument which was taken by the revenue before the High Courts and also the Supreme Court was there is a Section 41(1) which is applicable in these kinds of write back. And write back is basically, they said that because in case of trading liability for which an expenditure is claimed is returned back subsequently, in that situation Section 41(1) applies. So they said that since it was a liability taken on in the course of the business and subsequently there was a write back of this amount, so therefore Section 41(1) applies. The court held no, this is not a trading liability, this is a liability. The loan is a transaction on capital account, you cannot treat it as a trading liability. Secondly, you have not claimed the expenditure of the principal amount and therefore the write back of the loan cannot be regarded and cannot be taxed under Section 41(1). So they said that neither 41(1) applies, neither Section 28(4) applies. Now coming to the second component, which is the interest portion. Now interest portion will depend upon whether or not the interest expenditure has been claimed as deduction, as a tax deductible expenditure by the taxpayer in its return of income. In case the interest expenditure has been claimed as tax deductible expenditure in his books of accounts, and subsequently if there is a write back of that amount or the waiver of that amount, in that situation that interest portion will be subjected to tax under Section 41(1), and to that extent there is no dispute. So if I may just summarize, insofar as the principal component of loan amount is concerned, when you write back the loan amount, it will not be subjected to tax under the provisions of the of the Income Tax Act as per the law as it stands today, and it makes no difference whether the loan was taken for capital account purposes or revenue account purposes. But insofar as interest component is concerned, once you claim the expenditure and there is a write back of the interest expenditure, in that situation it will be subjected to tax. And just to add over here, an argument was taken before the Supreme Court was that in case of a capital asset also, the assessee claims the benefit in the form of amortization and depreciation, and therefore Section 41(1) applies in order to bring the write back to tax. Supreme Court said that these are two different transactions. Acquisition of an asset is a different transaction, borrowing of the money is a different transaction. So when there is a haircut or a write back of the loan, that is with regard to the transaction of loan, which is a liability side, and when it is returned back, it is a transaction on capital account, it is not a write back of the trading liability, and therefore that is not subjected to tax. So in sum and substance, write back of principal amount is not liable to tax. Write back of interest portion will be subjected to tax so long as the interest expenditure was claimed and allowed as reduction in the earlier years. Now I may just touch upon one more section, 56(2)(10), because 56(2)(10) was not there when these judgments were pronounced. Now what 56(2)(10) says, that if any taxpayer receives any money without consideration or for inadequate consideration, in that situation it will be subjected to tax as deemed gift. Now in our view, 56(2)(10), because normally the department also seeks to apply 56(2)(10), according to us 56(2)(10) is not applicable because there is no receipt of money, because for 56(2)(10) to apply there has to be a receipt of money. So in sum and substance, principal not taxable, interest taxable depending upon the nature. And I may just touch upon the second aspect with regard to the write back for the purpose of book profit. And I'll also request Mr. Wohler to supplement on the issue of book profit. I'll just point out the issues and then I'll request Mr. Vora to supplement. Now, book profits, as I understand, the book profit, as we all know, is based on the as profits as per the profit and loss account computed as per the Companies Act. Now, there can be two kinds of accounting entries which may be passed for the write back. One, you may credit it to the profit and loss account, the write back portion, or secondly, you may take it to the capital reserve. What we understand is that post the implementation of Ind AS, it is no longer possible to transfer the write backs to the capital reserve. It will have to be routed through the profit and loss account. So in that situation, a larger issue which arises, that in case of a restructuring or a compromise, which is a capital account transaction, and the amount is credited to the profit and loss account because of the compelling circumstances laid down by the Indian accounting standards, whether or not that can be subjected to tax. I think I'll toss off this question to Mr. Vora to explain this position, sir.
Thank you, Rohit. Satvinder, if I can take the liberty, I just want to preface the reply to this query with reference to certain preliminary observations. I think NPS, you mentioned in the beginning that, this is the time now for corporate restructuring in order to take a tax advantage. I would like to caution all the viewers who are listening. Today, we have the provisions of GAR in the income tax statute. So please don't envisage a scheme which is only for tax benefit. And I think that will sound the death knell of business. The scheme must first be driven by commercial considerations and business consideration. It must make economic sense. Tax advantage will be incidental. And between equal modes of restructuring, you may choose the mode which leaves you with a lighter tax burden. So I think I just wanted to add to what NPS said in the opening remarks. And to Satvinder's point on compromise, Satvinder, you would recall the matter that we did in the Delhi High Court. I just want to say the compromise, when Satvinder talked of being binding on the shareholders or the creditors, if it is approved by the majority, it must be approved by the majority of that class of shareholders or that class of creditors. If you remember, we did that matter in the High Court, where the scheme of amalgamation provided for flushing out minority shareholders by paying them cash, and ultimately one of the dissenting shareholders objected, who was paid cash for his shareholding, and he was actually moved out of the company. And the High Court ultimately accepted our proposition that and he wanted to claim that since he held below a certain number of shares, he was a separate class of shareholders who needed to be treated differently. So the High Court rejected his contention and said that all shareholders who have the same rights and whose shares rank pari passu will be treated as one class. So I thought I just wanted to refine that point. And Rohit, to your point, I just wanted to add on interest. When you said interest claimed and that will become taxable, I think I just want to add claimed and allowed deduction. So Satvinder, to your point, even if the interest is debited to the profit and loss account, but if the interest is payable to a bank or a financial institution and it has not been paid, it is disallowable in terms of section 43B. Now, if it is disallowed under 43B, it cannot be taxed under 41(1) on waiver of that interest. Now, to come to Rohit's point, I think the point that you made, that once you are mandatorily required now to credit the benefit in terms of waiver to your profit and loss account, having regard to the applicable Ind AS standard, I would think that since this is a capital account transaction, this is really not part of your book profit. This is not profit from working or operations of the company. So notwithstanding that this is credited to your profit and loss account, this should not form part of computation of book profit for purposes of section 115 JB. And I think one can draw support from several decided cases where it has been said, a capital receipt, even though credited to the profit and loss account, will not form part of book profit. So here also, this is a transaction on capital account. The loan obtained was a capital account transaction. The waiver equally is a capital account transaction, which eventually affects only the balance sheet. The loan amount gets reduced and actually your capital gets increased. It does not impact the profit. So in that view of the matter, I think having regard to settled judicial principles, one can claim that notwithstanding this waiver of loan or the principal amount of loan is credited to the profit and loss account, it should not be reckoned as part of book profit on which tax is leviable under section 115 JB. So I think this is I think the position that can be reasonably taken.
I think Satvinder sir, if I just supplement over here, I may just also point out there are two new sections which have been incorporated in the Income Tax Act. One is section 115 BAA and one is section 115 BAB. So that is basically 22% rate of taxation and 15% rate of taxation. And if the assessee opts for either of these two sections, because here you have to give up certain deductions. So if the assessee opts for these sections and want to be governed by this new regime of taxation which has been introduced in 2019 only, in that situation there is no book profit which is applicable to these taxpayers. So an assessee can also think over it, that in case they want to avoid this. Of course, one view, as Mr. Vora said, that it's a capital account transaction. One can reasonably argue that no book profits are not on the right back, book profits are not applicable. But at the same time, one can also explore the possibility of opting for these sections, and in that situation, the provisions of 115 JB would not be applicable.
Another question I have with you, you referred that the one matter which we did in Delhi High Court. There was another matter, I think few years back we did it, where there was the compromise, we worked it out amongst the disputing shareholders, where part of the properties of the companies we had distributed, and those were immovable properties. And we then analyzed the deemed dividend issue. Is there any change in law after that, or the law remains the same on the deemed dividend? If you can just...
I think what Satvinder is referring to, and I just very briefly touch upon the facts of that case, and that is still relevant and it is still good law today. Normally, as one understands, you distribute dividend in cash. Now here there was, I think, disputes between the shareholders, warring set of shareholders, which were never capable of being resolved because there was some valuable immovable property at stake. And ultimately a compromise was effected, or an arrangement was effected between the shareholders that they would distribute the properties between themselves. So there was a scheme that was evolved, which was filed in the court. And the scheme envisaged distribution of properties, and in other words, distribution of dividend in species. So the issue arose about the tax implications of such a transaction in the hands of the receiving shareholders. The shareholders were to receive immovable properties which belong to the company. And in that view of the matter, the question arose whether this receipt of immovable property becomes liable to tax in the hands of the shareholder. So there is a particular section 222 in the Income Tax Act which brings to tax deemed dividend, and distribution of assets to the shareholders while the company is still a going concern or is not liquidated is regarded as deemed dividend in the hands of the shareholders, but it is subject to tax only to the extent of accumulated profits that are enjoyed by the company up to the date of distribution. So this, in that particular case, since there were no accumulated profits, the company was not really operating, not generating profits, there were hardly any accumulated profits. So the fair value of the properties on the date of distribution and up to the ceiling of accumulated profit was regarded as deemed dividend in the hands of the shareholders. Incidentally, Satvinder, recently,
Yes.
just a few months back, now the question arose, one of the shareholders wanted to dispose the property. So he wanted to understand what will be the cost of acquisition of this property in my hands for computing capital gain when I sell the property today. So drawing on what we did, almost 7-8 years back, the view that was given was that the fair value of the property which was taxed in your hand, notwithstanding that it was not taxed in the absence of accumulated profit, but the fair value which was considered as part of deemed dividend will become your cost of acquisition.
Yeah.
So I think that stand is still alive and kicking today also.
Right. So I think
I in fact feel since Satvinder sir explained the perspective of compromise, there is another term which is used in section 230 and which rather covers the entire gamut of corporate restructuring, which is arrangement. So before we move forward, Satvinder sir, I would request you to please explain the contours of the term arrangement and what it can contemplate.
See, NPS, the word arrangement, when I talk about, if you see the explanation to section 230, it's an inclusive definition. The way they have said that an arrangement includes even dividing the one class of shares into a different classes or consolidating two or more classes of share into one class. So it's an inclusive definition. It's not an exhaustive definition. The connotation of that word arrangement is very, very wide. No, you may include even a merger, you may include demerger in it, you may include slum sale. And we had the chances where even the slum sale, because some clients were looking at a stamp of the code, we got it, the slum sale through the court process also. You may even see that reduction and buyback where we are talking about, and you mentioned in your preface opening remarks, even that can also be considered as this, where we can club it under section 230 to 232 or independent of that. So the definition of that word arrangement is very, very wide. No, what I'll do is, I think it's a very important issue you have raised, because once you take it this, let me take you one by one on briefly on this. I will not going into the nitty-gritty of each the issues. Let me take the first example is the amalgamation. Now, in normal course, we do this, but eventually, if you look at it, there are 2-3 important concepts. In amalgamation, the first basic concept is that in amalgamation, the amalgamating company gets dissolved without the process of winding up. So that's a one contour which is part of that amalgamation, which you have to take it. The second important aspect is the consideration. Now, normally people feel that in amalgamation, you have to issue equity shares, but I have used the word consideration, and that's very, very important. Now, look at it. I'm just saying from the accounting perspective. Now, earlier we had still relevant, that is AS 14, which was the accounting for amalgamation, right? Now, there were two methods were given. One is the pooling of interest method, and another is the purchase method. In the pooling of interest method, the word used was that, okay, you have to allot equity shares. But in the purchase method, that they said that, okay, you can allot consideration, which may be cash. Now, look at it in Ind AS. Under Ind AS 103, they have changed the concept. They have changed that, okay, you are acquiring a control when you have to acquire a control. And in that perspective, they said that consideration will include cash, preference shares, the ordinary shares, even the contingent consideration, options, warrants. So they have, even under Ind AS 103, the definition of consideration is very, very wide. I think from tax perspective, that's what I was thinking that Rohit and Mr. Vora can touch upon. But before I take it, that's another part is the consideration. The third important aspect, which is very, very relevant, and particularly when you deal with the scheme, is the concept of appointed date and effective date. Now, one is that you, and largely people do it even at the time of filing, the appointed date can be fixed retrospectively, and there is no law as such, and the appointed date can be even prospectively. You will see many schemes, like we did that scheme of Idea and Vodafone, where our proposal was that the appointed date would be an effective date. And when is the effective date? Effective date is when last of the approvals has to be received, right? Now, you look at under 232.6. 232.6 says that, okay, you have to mention the appointed date, and then the appointed date, then the scheme has to be implemented with effect from the appointed date, what you have prescribed in the scheme, and not subsequent to that date. That is under 232. Now, what was going on? So this is a dichotomy. Here, if you have to take a license from any regulator, he said, okay, you get the scheme approved, then I will consider, and then I will issue the license. On the other side, the NCLT is saying, or the MCA was saying that, okay, no, you have to mention the appointed date. So I think, and we had faced this situation also. But the point where I is that later on MCA also realized this aspect, and they came out with the circular where they said that where if the appointed date is linked to the occurrence of any event, like you have to take a license or you have to seek that approval, I don't mind. You can take it. It can be tiered. So they have given all the leverage. But they says that's 2-3 aspects they have given. One, that you can fix it. That's not, but you must mention that where that the occurrence of event in the scheme itself. That's a one part. Secondly, they are saying is that, okay, once you will get it, And once the code scheme is approved, within 30 days you have to file within the with the ROC, the order of the NCLT. And once that is filed and that approval from the authorities has received subsequent to your filing the order with the ROC, then you must intimate that this is the appointed date for the record purposes of the ROC. Now that is the one part. But I think the point which I'm just making it is that appointed date is, again, it's a theory where we are just making it is, and it is very, very relevant when we are doing the structuring of the transaction, and we have to see that how best we can take the benefit of determining the appointed date and that effective date. Effective date is only when the order is received. But Rohit, I have an issue to you is that when, and normally it happens is that when the appointed date is fixed retrospectively, what complications you feel that from the accounting and the tax perspective that you face normally when these issues comes? Can you just let us know that tax and accounting complications, particularly when the appointed date is fixed retrospectively?
Yeah, before I come to the accounting and the tax implication, when we need to understand and aspect needs to be clear that under the scheme of amalgamation, the consequence of the amalgamation is on and from the effective date, the amalgamating company ceases to exist in the eyes of law. There's an automatic winding up of that amalgamating company which happens. Now, the difference between the appointed date and the effective date, as you explained elaborately, is that the appointed date is the retroactive effect has to be given of the scheme. So what it basically means is, I'll give it with the help of a simple example. Let's say the appointed date we keep under the scheme as 1/4/2019. I filed the scheme sometime in the month of May 2020, April or May 2020, and the scheme ultimately gets approved, say sometime in December 2020. Now, so therefore, there are two dates. December 2020 is the effective date when the scheme is ultimately approved. I filed the copy with the ROC, etc., and the company ceases to exist. But the appointed date I have kept as 1/4/2019. So which effectively means that on and from 1/4/2019, all operations which were carried on by the amalgamating company actually belongs to the amalgamated entity. So therefore, what I have to do, I have to reconstruct my accounts. I have to re-prepare the accounts of the amalgamated entity, which is the amalgam of both the companies, the amalgamating company as well as the amalgamated entity. I have to re-prepare their accounts in order to merge the results of the amalgamating entity with the results of the amalgamated entity. So I have, so for example, if I had a turnover, I have a profit of 100 crores in the amalgamating company, I have a profit of 150 crores in the amalgamated entity. So for the financial year 2019-20, I will have to re-prepare the accounts, and the re-prepared accounts would be 250 crores of the profits of the amalgamated entity. Now I have to regularize it, because by the time December 2020, I would have filed the income tax returns both for the amalgamating entity separate returns as well as for the amalgamated entity. But that is not the legal effect of the amalgamation, because as per amalgamation for financial year 2019-20, the profits only belong to the amalgamated entity, which is 250 crores, whereas the return which I have filed is 100 crores and 150 crores. So I will have to perforce refile my income tax return of the amalgamated entity. Now here comes the complication. The complication is, by the time the scheme gets approved and the effective date comes, the time for filing a revised return may have lapsed. Now what do I do? Now here comes the important aspect, that most of these schemes, and in fact it is very important that the scheme should specifically provide that once the scheme become effective, then I should be allowed to file my revised return even if there is no time limit available for filing a revised return. Because in the absence of that mandate, there are complications which arise, because normally the income tax department says that once the time limit for filing the revised return expires, in that situation you cannot file a revised return, and therefore we will not accept your revised return and your revised return will be invalid. Now this controversy recently came up before the Supreme Court. Now in one case what happened was, there was an amalgamation of company A with company B. The company B, after the amalgamation, filed its revised return of income, and when it filed the revised return of income, the time for filing the revised return had already elapsed. So the department refused to take cognizance of the revised return. The assessee or the taxpayer filed a writ petition before the Madras High Court. The single judge of the Madras High Court in the case of Dalmia held that since the NCLT scheme specifically provided for enabling the taxpayer or the amalgamated entity to file its revised return of income, so therefore the department cannot say that we will not permit you to file the revised return, and the scheme is binding on the income tax department, and once the scheme is binding, they cannot refuse to take cognizance of the revised return. Unfortunately, when the writ appeal was filed by the income tax department, the Madras High Court division bench reversed the judgment of the single judge, and they said that in the absence of any provision for filing the revised return, the assessee or the taxpayer cannot be permitted to file the revised return. On further SLP, the Supreme Court recently in the case of Dalmia Power specifically considered 3 issues. One, they reiterated the principles of Marshall-Son, wherein they said that the Marshall-Son principle is that once the scheme is effective, you have to give effect to the scheme with retroactive effect from the appointed date, and therefore the profits of the two entities have to be merged. They also took into consideration the provisions of section 170 of the Income Tax Act, which specifically said that in case of a succession where the predecessor cannot be found, the successor will be subjected to tax in respect of the income of the predecessor. They said, the Supreme Court said that once the amalgamation has taken place and the amalgamating entity ceases to exist, it is incumbent on the part of the income tax department to take cognizance of the revised return in order to determine the correct taxable income, because the correct taxable income of the amalgamated entity is 250 crores of profits. If you don't take or regularize the income tax returns after taking into consideration the amalgamation, you are actually not determining the correct taxable income. So therefore they reiterated the Marshall-Son's principle. Supreme Court referred to section 170. Then they also said that the scheme of amalgamation, once approved by the NCLT, is binding on the income tax department, and they specifically said that it is open to the income tax department to raise its objection within 30 days before the NCLT, and once they don't raise any objection before the NCLT, they cannot be permitted to say that now the scheme is not binding on us. And in fact, it sometimes puzzles me, why should an income tax department actually object to the assessee filing a revised return only to give effect to the amalgamation scheme? Because that's a legal consequence of an amalgamation. If the legal consequence of the amalgamation has to be given effect to, there is no reason why they should be objecting to a revised return being filed by an amalgamated entity. So this is a one practical issue which normally we faces. So therefore it is important to very carefully draft the scheme. Other two, sometimes the practical issues which arises is the credit of the taxes. So amalgamating company pays income tax, prepaid taxes, there are various TCS, etc., which are paid in the PAN of the amalgamating entity. Now, when I claim those tax credits in the hands of the amalgamated entity, department sometimes says that PAN is not because this tax has not been paid under the PAN of the amalgamated entity, the credit will not be allowed. Now, I don't see why they should not be allowing the credit of the. So therefore, all these things should be built into the scheme itself. That's very important and critical, according to me.
I think very well explained, Rohit. I think that issue, sir, Vorasab, if you see where he was saying that why the department is objecting, and you and I had a chance where you see on that reverse merger, I'm just making it as.
Satvinder, before you bring me on the reverse merger, I am tempted to speak a few issues on what Rohit has mentioned, and I am tempted to. I recall so many cases that I have handled and which touch on various nuances. So first, NPS, to your point, how do you define arrangement? Yeah, as a term of English language, I will answer it in the negative. This impromptu teet-a-teet is not an arrangement. And as Rohit speaks, I am recalling so many instances that come to my mind on, this consequences of appointed date. Now, first on this Dalmia Power, in fact, I had a discussion with a contemporary, practicing before the Gujarat High Court, a senior advocate. He was saying this Madras High Court judgment is the correct judgment and the Supreme Court has gone wrong because an amalgamation is a contract between shareholders and creditors. Now, in my view, yes, it is a contract at that stage, but once it is approved by the court, it has the operation of law, as Satvinder referred to the SK Gupta judgment. It is binding on all stakeholders. So I think, in my view, the Supreme Court has taken the correct position that once a scheme is sanctioned, it has the operation of law and it is binding on all stakeholders, including the income tax department. Then on this appointed date, Satvinder, I remember now there are cases going back to 20 years in my memory. There was an old case of HCL, and this is very interesting. The appointed date was for a period when the amalgamated company was not even incorporated. And the question arose that the amalgamated company was not in existence on the appointed date. Now, how do you tax the income? So the tax department said, from the appointed date to the effective date, we will make an assessment on the amalgamated company. And I raised the point that you can make an assessment on a person. That amalgamated company was not even incorporated at that point of time. How can you call it a person? So while your courts and the NCLT allows this flexibility of having a retrospective appointed date, these practical issues can come. Then Rohit raised this question of the credit of certificates and all. But more importantly, and he referred to section 170. After the amalgamation becomes effective, the amalgamating company is dissolved without winding up. It ceases to be a legal entity. It ceases to be a person. Now the tax department has been reopening assessments of the amalgamating company for a period prior to the appointed date and issuing notices framing reassessment in the name of the amalgamating company. We have successfully challenged this before the Supreme Court, and the Supreme Court in the case of Maruti Suzuki said that you cannot make an assessment in the name of the amalgamating company which has ceased to exist in the eyes of law, even though it pertains to a period prior to the appointed date. So here also is an important issue that needs to be taken into account. Then Rohit raised this point about the income of the amalgamating company from the appointed date to the effective date being taken as the income of the amalgamated company. Now in one case, what the tax department did was that the amalgamation was effective, let us say 1st of January. So 1st of January to 31st March, the income belonged to the amalgamated company. Income of the amalgamating company was to assess as the income of the amalgamated company. Now they did a straight 9/12, and they said 9/12 to the amalgamating company, 3/12 to the amalgamated company. Now we showed to the tribunal that look at the flow of income, look at the expenditure. The expenditure that was, and we drew up a transaction by transaction account for the amalgamating company up to 31st December, and for the transactions post 1st January, and ultimately succeeded before the tribunal that what you can tax in the hands of the amalgamated company for that 3-month period is the actual result of the transaction. So these are practical issues that arise on a day-to-day basis. And now you are questioning on the reverse merger. Yeah, you can.
I was just making it is because you see.
I'm sorry I took you in the reverse, but this was necessary.
No, why I'm saying it is because you and I, we really contested where in the reverse merger, though the process under the Companies Act is same. And when there was a reverse merger in one of our recent matter, which you argued before the NCLT, you see, since there was a reverse merger, highly profit-making company was getting merged into the loss-making company. No, in that case, I had a discussion with the counsel there also of the income tax department. They were saying, no, we have the standing instruction where there is a reverse merger, you involve the implication of GAR. So I'm just making it is that how you feel that GAR is applicable where their corporate debt restructuring schemes are there and other things. I would like to have that, let the audience be benefited out of that, the matter you argued it.
In fact, I sat with you at the NCLT for a couple of days before our matter was taken up, and I must say, with due respect to our friends in the tax department, I think these schemes are ultimately meant to revive the business of the dying or the stressed company. I don't see why they should be raising objections in almost every scheme, except benefiting professionals like us. Yeah, certainly, we would welcome these kind of objections for furtherance of our professional practice. But I think it is not in the larger interest that these objections should be raised. Now, a reverse merger may be resorted to for multiple reasons. And I think tax is the least of the benefits. Unfortunately, that's an old mindset that the tax department feels that if you have a reverse merger, a loss-making company, instead of a loss-making company being merged into a profit-making company, you merge a profit-making company into a loss-making company to take advantage of the tax losses. It may not be true in every situation. You have to test it on the facts of a given case. So here, basically, if the intent is to revive the business of the loss-making company, and there are compelling reasons why you shift or amalgamate the profit-making company into the loss-making company, I see no reason why it should be objective. And I think to the point that Rohit made, that you can't, as a uniform rule, seek to raise objection in any and every case. You need to test it on the facts of that given case. And in the precedent that you are mentioning, we had the loss-making company, which was a high fashion label, and the promoter's intent was to revive that high fashion label business, which needed capital. And that capital was available in this amalgamating company, which was otherwise in the nature of an investment company. And that investment company was bringing its funds into the loss-making company, so that the loss-making company had necessary, interest-free capital in order to revive the business. And we were able to demonstrate to the NCLT that, look, this is not intended to get any tax advantage. This is not intended to, gain any unfair tax benefit. On the contrary, the amalgamating company was losing some of its losses. For instance, capital losses of the amalgamating company were getting lapsed because they don't get absorbed in the hand of the amalgamated company. So we were able to demonstrate with reference to exhaustive facts that there was no tax advantage which was driving this reverse merger. And therefore, on the facts, the approval ought to be given, which was rightly given by the NCLT. So merely a reverse merger is a stigma that is attached, that it is for some ulterior or oblique motive, but that may not be true on facts of every case.
So if I may just add on, Satvinder sir, if I may just add on, say for example, in case of a direct merger, as we normally say in loose terms, because there is no such concept otherwise of direct merger or reverse merger. But when we talk of direct merger, there is a specific provision, section 72A, which says that the losses of the loss-making company, which is the amalgamating entity in direct merger, when it merges with a profit-making entity, then section 72 says that if you comply with certain conditions, then the losses of the amalgamating company would be available to the amalgamated entity. And basically, the three fundamental condition is that the amalgamation should take place in order to revive the loss-making entity. The second is you should continue to run the business of the amalgamating entity for a period of 3 years, and you should continue to hold the assets of the amalgamating entity for a period of 3 or 5 years. Now, in fact, I was debating with sir that in case of a reverse merger also, supposingly if I were to hold and continue with the business of that amalgamated entity, which was earlier the loss-making entity, for say next 5 years, I were to continue to revive. In fact, the intention of the merger is to revive the business of the loss-making entity, to bring in the resources of the profit-making entity, and I continue to hold the assets for a period of 5 years. Then I think even in that situation, even in terms of the provisions of section 72A, the guard should not be applied in such kind of a situation.
What? Your observations are bang on. Clearly, this is not driven by any unfair tax advantages that you seek. It is driven totally by bona fide business commercial considerations. And there is a commercial rationale, economic rationale, why the profit-making company is merging into the loss-making company. So one has to see it from the perspective of the businessman, and not sit in the armchair of the and the revenue should not sit in the armchair of the businessman to say that this is a merger motivated totally by a tax consideration.
Very right, sir. And at least I would say that even that matter you argued, I was personally benefited the way you made us, that you made each and every chart showing that, okay, where it is being, we are rather having a losing proposition had it been a ordinary merger, and we got the scheme approved despite the resistance by the income tax department. The scheme should not be approved. But I think the point which I'm just taking it to you is the other aspect of this thing, that normally people come and ask me, Satvinder, should this is the we need to hive off it, and whether we should go for a demerger or we should go for a slump sale. And I always ask that, okay, you have to see the objective and the perspective. What do you want to achieve out of it? Do you want that do you want to hive off the businesses assets just to make it as part of that family settlement, where you see there is a company having different businesses, the dispute arises, and you see that, okay, let's settle and divide the businesses into different companies, and then you look at it as a family settlement for this thing, and then so it's going to be you have to see to it whether you want the consideration to flow in the hands of the shareholders, or you want the consideration to flow in the company itself again. So that will also be there. Then whether you need the tax neutrality or you are needing only a tax efficiency, which one can look at it even from the slump sale perspective. Time is also the essence where one can look at it. Then the issue is that whether if you have that losses pertaining to the undertaking, whether you would like to take that losses into the resulting company, or you would like to hold that losses in that company. So there are different aspects, and simultaneously when we talk about a demerger, where there's a provision that, okay, the shareholders of the demerged entity has to be the shareholders, and you have to issue the equity shares. Unlike in amalgamation, I can issue the preference shares also, but in slump sale that is out. So there are different perspectives and that basic questions which we have to see to it. But one important aspect always comes when we discuss about is Rohit, and I am asking you and Rohit on this thing, is as when this issue comes, because in both in the case of demerger as well as in the case of service, they says you have to transfer the undertaking. And when that's an undertaking, they says undertaking is a business activity as a whole, but it includes part of the undertaking also. No, ultimately it's a business activity. But particularly when I'm saying that I am doing different verticals, but some verticals I am doing it through my wholly owned subsidiaries, where there are I have made that, but that investment, if tomorrow I am saying that, okay, I have to hive it out and I'm demerging that investments as as part of that investment as a bouquet into a resulting company, how far from the tax aspects, whether from the Companies Act, I don't think that I will have an issue. That from the tax efficiency purposes, do you see that, okay, one can look at it that can also be constituted as an undertaking?
I think, Satwinder, before Rohit answers this specific question, on the larger issue that you have raised, you see, what I would do is prioritize my objectives. As you mentioned, to decide the mode of restructuring, you must be clear as an entrepreneur, as a businessman, as an industrial, of the objective that you seek to achieve. And
Yes.
Those are commercial objectives. And then I would put down for each objective the pros and cons. Like you said, if you resort to a demerger, even the resulting company will have the same shareholders as the demerged company. Now, if this is not acceptable to the businessman, if this is a no-go, then in that situation you rule out a demerger. So therefore, prioritize your objective, list out the advantages, disadvantages of each objective, and then decide what needs to be done. I think that's my advice.
The point which I'm making, it is like a family settlement. Suppose if I demerge one business, it's a vertical split, the same shareholder. But at the end of the day, because it's a related part of the same family, now there is a dispute, you swap that shares among this thing, and then subsequently that own. So it meets that family settlement objective also.
That's right. Perfect. Yes. Certainly.
So if I may just add on, I'll come to, sir. I'll just briefly touch upon amalgamation, demerger vis-a-vis the slum sale, and then I'll come to the issue of family settlement as well as the issue of undertaking. So what is important to first understand is the tax implications of these structures. Amalgamation and demerger, as we all know, these are tax neutral. They are considered as tax neutral. There is no consequence, there is no tax implications involved, provided you satisfy the conditions as provided under the Income Tax Act, which is Section 219AA and Section 21B. And they are pretty straightforward conditions. I don't want to delve into those conditions. But as Mr. Vora and you rightly pointed out, we have to first decide, and we have to be clear in our mind what is the objective which we want to achieve. Because objective is the prime purpose, whether you want to go for an amalgamation, you want to go for a demerger, or you want to go for a slum sale. Because every structure has its own pros and cons. So for example, in case of an amalgamation is a tax neutral exercise, but the one company ceases to exist and it merges with the another entity. So there is only one entity which may exist after the amalgamation. In case of a demerger, supposedly, as you said, in case of a family settlement, there are two brothers. Let's take an example. There are two brothers running a company and which has two units, and both the brothers are taking care of one unit each, and they now want to divide the businesses in order for larger family interest. So in that situation, one alternative would be I do a demerger of the one of the undertakings, I take it into the other undertaking. What will happen is that these shares of the demerged entity will be distributed to the shareholders of the demerged entity. Shares of the resulting entity would be distributed to the shareholders of the demerged entity. And thereafter, once the merger takes place and one undertaking goes into the other entity, thereafter what I can do is I can swap the shares. So the shares of the resulting company may be gifted by one brother to another brother, and depending upon the family settlement, they can divide the businesses. That is one part. Now slum sale, in slum sale what will happen is, if I were to instead of following the scheme of demerger, if I were to transfer the business by way of slum sale, in that case, as you rightly said, the consideration will flow from the buyer to the seller entity. It will not go to the shareholders of the seller entity, and therefore you may not be able to achieve the objective of the family settlement, which was the prime objective for undertaking this exercise. So therefore the objective is very relevant. I'll just add on over here one more important aspect is that family settlement under the income tax law is treated as only merely realignment of the family interest. So what I get is what was always owned by me. So for example, if there is a house and the house is in the name of brother A, and brother B is also residing in the same place, and if the house were to be divided into amongst the two brothers, in that situation one cannot hold that brother A has transferred the house, part of the house, to brother B, and there would be tax implications, because the courts have held that these are only realignment of the family interest. So similarly, in case of demerger, if I were to demerge the undertaking and then swap the shares in order to effectuate the family settlement, that I think will be a reasonable exercise. But in the case of a slum sale, now we have to see the advantages of demerger versus slum sale. Now in demerger, you are able to take the benefit of the losses. So the losses of the undertaking which is demerged and relatable to that undertaking will go along with the undertaking to the resulting company, and the benefit would be admissible to the resulting company. Whereas in case of a slum sale, the losses will continue to rest in the seller entity. It will not go. So if the objective is not to transfer the losses to the resulting entity, the transferred entity, in that situation, the demerger may not be the correct option for the purpose. And one important aspect which I want to know, and which may be relevant in this COVID crisis, is as a consequence of amalgamation and demerger, section 72A triggers in, and section 72A1 it triggers, it gives a fresh lease of 8 years of life to the unabsorbed losses. So supposingly someone were to in some case, this is the 7th or the 8th year of the loss, and because of the COVID crisis, actually there may not be any adequate profit to set off those losses. One may contemplate fusion of two or more the entities in order to give a new fresh lease of life of 8 years to those losses. Of course, there will be issue with regard to the GAR, but I think if there is a commercial rationale for any structure, I think that will the scheme should pass through. And I'll request Mr. Ora if he could want to add anything. I think this is what, according to me, are the broad concepts.
As Satvinder NPS, there was no arrangement for you to pay fees for my appearance, so one really didn't apply much mind to beforehand. But as Rohit was speaking, I this is coming to my mind, this Glaxo HUL merger. I think this is a classic case. Glaxo wanted to move out. Glaxo UK wanted to move out of Glaxo SmithKline here, and HUL wanted to acquire the business. Now look at the ingenuity of this scheme. Glaxo has merged with HUL. HUL issued its own shares to the shareholders of Glaxo, which is the UK parent. Now, there is no cash that has moved out of HUL. It has acquired the entire business of Glaxo. This is now part of HUL. and Glaxo's parent has disposed of HUL shares on the stock market, and I would assume it's tax-free income because having regard to the grandfathering provision. So in this merger, look at the priority that they have done. There is no cash that has moved out from the amalgamated company. The undertaking of the amalgamated company has merged into the amalgamated company. It has become now the business of HUL. The shareholders of Glaxo have received consideration tax-free by selling their shares on the stock market, and they have received some, I think, from what I read in the paper, some 3,000 odd crores for selling the brand. So the cost to HUL of acquiring this thousands of crores company is just issue of shares which have already been sold and now are owned by some other shareholders. I think
you have very rightly said that, okay, because under the resolution plan also, where these days the companies are cash starved, I think that is also one way of looking at it, is how you can structure it and make
Yes.
it, and you see, capitalize or monetize your shares and bring it cash in the system through the shares. I think that's one of the very good example you have given it. I think the
Right.
time is
So
short.
there is great flexibility in your corporate restructuring. There is great flexibility.
So time is little short, sir, because we have to give it to the audience also.
I just want to add one dimension to this corporate restructuring. You see, under the Income Tax Act, there is this transfer pricing regulations which apply to an international transaction between an Indian resident or a permanent establishment of a foreign company and associated foreign enterprise. Now, the definition of international transaction has been widened to include business restructuring. This has not been tested in any court, but the tax department seeks to suggest that we can sit in judgment even in a case of business restructuring to make a transfer pricing adjustment. Now, with reference to various schemes of restructuring that you have outlined, one will really have to see whether there is a transaction between an individual shareholder and the company which is undergoing the restructuring exercise. To my mind, the answer will be no. It will be a decision of the majority of shareholders, the majority of creditors, which will ultimately get the approval of court. And therefore, there should be no transfer pricing adjustment. The same may not follow for a slump sale. But this is also an important consideration that people will have to keep in mind, that there can be exposure to transfer pricing adjustments in certain situations. So I thought I'd just flag this issue.
So before, sir, I think the time is short. Last but not the least, I would like to take another aspect of the reconstruction. Why I'm saying so is that when NPS had said that, okay, sir, how do you express that arrangement? And I said that even the reconstruction is also part of that arrangement, where you can make it under section 230, because the definition of arrangement includes dividing it, even where you are saying that, okay, converting the preference shares into loans. And we have a live case, you see, recently the Reliance Jio matter, where it was a composite scheme. The optic fiber business, they have demerged it. Infrastructure business, they have made a slump sale. But one important aspect which they made it, because the Reliance Jio was 100% subsidiary of the Reliance, and the Reliance had subscribed the preference shares of Reliance Jio, which was the optionally convertible, and they didn't want that option. They have to redeem it. So in that case, so they made it as part of that scheme, where they said that, okay, this scheme, through the scheme, otherwise, if you see section, I would say 55 subsection 2, the redemption of preference share is given that, okay, you can redeem it either out of the profits of the company or by bringing in fresh capital for the purpose of redeeming that shares. Now, in that process, under section 230, they have converted their preference shares into the loans. Now, that's a one important aspect. NCLT approved it. On that basis, they said that the objection by the income tax department was that you cannot, it is against the provisions of the Companies Act. So NCLT said that, okay, it is not in your domain. Had that been objected by the regional director or by the registrar, I would have considered it. I'm not taking it for this thing. They went to the NCLT appellate tribunal. Appellate tribunal also made it, and they said that, okay, I am rejecting it as no obstruction for sanction of the scheme. But he put a caveat for this thing. However, right of the tax department to receive the dues in accordance with the applicable laws. That's the order, last part of the order. In accordance with the applicable laws are protected. So they are protected that this thing. No, I'm curious that since we are taking the benefit without any fee to be charged by you, why I was just saying it, how do you view, is that like we said that in our demerger case, they objected to it, they're making it is, how far even that objection by the income tax department for the conversion of you see the preference shares into loans, how far it is tenable, and how you view that, where will it lead to?
You see, from the facts of that case, I also read this NCLAT judgment in the case of Reliance Jio. Now, from the facts of the case, the conversion of the preference shares into loan is happening at the same value, I understand. Now, if the redemption of preference shares was to be at a premium, that would have given rise to capital gains in the hands of the shareholder at the time of redemption. Now, that could be one objection, that you have, kind of wiped out the potential capital gain tax liability in case the redemption was to happen in future at a premium. So the facts are not clear whether the redemption was to take place at a premium. Second, if the conversion of preference shares, which were ultimately repayable at the end of the stipulated period, is converted into loan, I don't think there is any change in the character of the amount. What was redeemable preference shares has now become loan, and it will be repayable depending upon the cash flows of the borrower company. So from a shareholder's perspective, I don't think it has any tax incidence. The objection that the tax department was raising, and from what I read in the NCLAT judgment, their stand was that the interest that the borrower company will now pay on the loan would be a deductible expense for the borrower company, which would bring down its profits and consequently bring down its tax liability. And they demonstrated some numbers that the profit will come down by a certain number and the tax liability will be reduced to that extent. So the NCLAT said, unless you are able to point out today any unfair tax advantage that is sought in the scheme, you cannot object to the scheme, although they have left it open to the tax department. So here basically, you see, unless you say this is just a device, and it cannot be a device because it is open to the lender company, instead of infusing capital, to have lent money in the form of loans, which would have been repayable. So I don't think that can be treated as a device. A. B. In certain countries, you have thin capitalization rules to say that a company cannot be thinly capitalized; it must have so much of debt equity ratio. In India, we don't have those thin capitalization rules, so the department cannot possibly say that this is the optimum debt equity ratio that a company must follow, and therefore any debt in excess of this limit will need to be disregarded and the interest disallowed. Thirdly, there is a particular section 94B, which only talks of interest payable by an Indian resident to an international associated enterprise or non-resident associated enterprise. Now, in that case, the interest on the loan payable to that associated enterprise is restricted to 30% of EBITDA. So that is the only provision in the Act. In the absence of that provision applying to this particular case, I don't see how the department can have an objection on conversion of preference shares into loans under this scheme of arrangement.
The one thing, sir, you see, by chance the Mamta is there, and she had also circulated one article on that Reliance Jio. And from that article, what I understand when I was reading Mamta's article also, that it is not only the conversion they have converted because they had subscribed it at a premium. And I think, Mamta, in your article, it is written, there is even a share premium is also getting converted into loan.
Yes, absolutely. So Ajay sir has rightly pointed out, Ajay sir has rightly delved into it. Ajay sir, we would just like to understand that in foreign countries, how does this kind of a amalgamation or reconstruction takes place? I'm sure, abroad also these kind of preference shares is a very common phenomenon abroad. Right. So I have read quite a number of articles where such kind of preference shares conversion into loan or equity is a very, very common phenomenon. I have never seen the tax authorities really questioning those transactions. Sure. In the Reliance Jio case, what you rightly pointed out, that the NCLAT said that show me what's happening now. don't come with the perspective that something is being planned and taxes
Tend to
being.
take a very narrow, pedantic view,
Yes.
you know, of the short run. You need to look at the larger long-term perspective. Why, as an entrepreneur, undergoing this restructuring exercise? And I'm sure it is not driven by this tax advantage. You are, as you saw, post this restructuring and what we read in the papers, the Geo platform has seen substantial capital infusion by international giants.
Absolutely.
So the idea is actually to raise resources in that company.
Yeah.
So
Very
that's
true.
the underlying objective, not the tax advantage. I think the advantage that is talked of in the context of the size of the Reliance Group is peanuts.
Yeah, and that's actually tax advantage is just incidental.
Yes, it's only incidental. And you are only changing the nomenclature. Today, dividend is also taxable, interest is also taxable in the hands of Reliance, in the hands of the shareholder, or today the lender. So I don't see any tax advantage flowing to Reliance as a result of conversion of this preference into loan. But as I said, this is our mindset that we must object to every scheme. Sitting in the NCLT with Satvinder, I observed that almost every scheme had an objection from the tax department. Now, for instance, in a case of an amalgamation, you are objecting that the amalgamating companies had a tax demand, and that tax demand is pending in first appeal, second appeal, that demand is not paid. Now, ultimately, if that company is to merge, that demand becomes the liability of the amalgamated company. You can recover it from the amalgamated company. I can't see why your objection should hold up the approval of the scheme. But it is happening on a daily basis. It is happening on a daily basis.
I think with the insolvency, sorry, Satvinderji, please. With the advent of the insolvency laws, where we are actually talking of really, getting a lot of freebies, if I may just call that, from the departments like income tax or sales tax, etc. Now the GST. I think these departments really rise.
Mamta, nobody is giving it voluntarily.
That's what, I think these departments should now rise above that thought. Because if the company just goes for a toss and for liquidation, these departments also get nothing. It's actually economic murder of that company. So it's high time now that these departments, and Ajay sir, I think you've done a great job by getting that judgment of the Rajasthan High Court. I was reading that in the case of the GST department, that if GST has been given a leeway under the plan, then there's no way that the GST department can sprung back again and ask that money back from the resolution applicant, that's a new company. I think that's a great judgment, which is, I think that's circulating everywhere. People are taking a great benefit of the judgment.
With the legislative spirit behind enactment of IBC in mind, I would think that the government intends all government departments to make a sacrifice.
Absolutely.
And as you very rightly put it, it is liquidation versus revival.
Yes.
If it is a case of liquidation, you in any case don't get anything. By seeking to revive the company, you may not get anything today, but in the long run, the exchequer will be benefited. You will keep people in employment. So I think look at the larger economic impact of revival of a dying business, then liquidating that business. And as we were discussing before we started this webinar, was on your PF dues. Frankly, I don't see how the PF department can have a locus in this matter. The PF department is only a custodian of the employee's dues. Now, if the law provides that the employee's dues beyond 24 months are necessarily to be waived, I can't see why the PF department should have a grievance.
You've touched such a crucial issue. I'm sure a lot of people who are listening to us will be hugely benefited.
But you see, last but not the least, you see, wherever I go to give a lecture on the corporate restructuring, one thing I always ask that as and when you are planning any corporate restructuring or M&A transaction and other thing, that if in the morning, if you are reciting Ram Ram or you are reciting Allah or you are writing, you are reciting Jesus or Vaheguru, when you are doing it, the corporate restructuring, one thing you have to do is stamp duty. So why I'm saying so is it's a subject in itself. So Sahib was asking me, sir, why not we should take it up, this thing? Then we said that, okay, if we start taking it up, maybe that session can go for another 1.5 hours. So what we had done is, so we thought that, okay, we should have a separate session on the stamp duty, where on 19th we have planned on that stamp duty from 3:30 to 5 p.m., where we will discuss separately the nitty-gritties of the stamp duty, state amendments, even that amendment which has come up, rather than taking it is because it's a subject in itself and it needs a detailed deliberation, where we see. So probably we'll take that stamp duty issues on 19th when we will have a separate session on that. So I'm making it over to NPS and Sahib. I see that.
As you very
He said-
rightly said, payment of stamp duty is actually an outflow. Now, in all
Yeah.
your models, this will be a con that needs to be taken into consideration before you decide on the mode of restructuring. I think
Yes.
very essential. You will want to prevent this outflow. So tax and stamp duty, I think, are common enemies.
See, I'm just making it is. I'm just giving you. I'm just giving one reference because I was doing one scheme, and in that scheme, I asked them that okay, because of HUL judgment, you one of the big four was the consultant. I said okay, you can go and get back to this thing. What would be the tax implications? So they simply came to me, no, you file it, and they came it. I'm telling you, the way back in 2011. They came back and they said, no, Satvinder, we just want to withdraw because now they're saying that there is a possible exposure of 108 crores. So that's the magnitude of that stamp duty which is coming. Probably we will discuss it when we'll take it up in that stamp duty session on 19th. So NPS sent me the message, sir, there are many questions coming. So but please leave some time for the question answer session. So I'm leaving it to NPS and Sahib.
Thank you, Satvinder sir. Thank you all the panelists. And Mr. Bora rightly said their tax and stamp duty are enemies. You know why so? Because I remember when I argued this matter in Delhi High Court on Delhi Towers, and I was briefing a senior counsel at that time. And I remember the kind of law which Justice Geeta Mehta laid down. Whether this was always in question, whether states would be bound automatically by the Supreme Court judgment, or if the state doesn't have the entry. In fact, we have received few questions already on the stamp duty, for which we would not be able to take up today, but certainly we'll be taking up it on 19th. But let me start with the questions which we have received so far. Mamta ma'am, we are fortunate. So as our country has two renowned Mamta Jis and Mamta ma'ams, and we are lucky to have one of those two Mamtas with us today. And in fact, I just got to know, and not from you, Mamta ma'am, so let me tell you that you have not shared. Somebody else just sent me a message that our past president of the institute, Mamta Binani, has been awarded as Insolvency Law Award 2020 from international advisory experts. So congratulations for that. And in that context, let me ask you the first question, Mamta ma'am. Now, as we all are hearing that insolvency proceedings and the new initiation may be suspended, there is another talk which has come in papers also that pre-pack may really become a reality in the country. Can we see pre-pack imbibed into a scheme of arrangement under this section 230? Can it be a reality?
Oh yes, definitely. In fact, today if we see section 230, it's actually a avatar of pre-pack only. You have to measure pre-pack in the context of IBC, because otherwise 230 is a pre-pack arrangement. In the context of IBC, let me first tell you the disadvantages because of which the country is still holding it back. One of the major disadvantages of pre-pack, but for the benefit of the participants, pre-pack is a pre-arrangement, okay, before the company is handed over to an insolvency professional. So what happens in today's arena is that an insolvency professional known as administrator abroad comes in, then he actually advertises and gets the best deal for the company. And then that deal works out, sees its pros and cons, and then sees the light of the day at the end of the tunnel. What happens in pre-pack, it's also known as pre-pack insolvency proceedings, is that a pre-packaged scheme is already discussed and decided. Then an administrator is appointed to give it a final shape and then take it to NCLT for getting the legal nod from the NCLT. Why do we need a proper legal nod? Is because now people have understood that if we don't get the legal nod, the fight and the clawback is what is known as. The clawback and the fight is so huge that even if a compromise is arranged into, it may just end up in shackles. So therefore, pre-pack with a legal stamp is what the country is looking at. Having set the tone, why we are still going a little slow with pre-pack is because of the basic fact that it is very much exposed to abuses. If you see a pre-pack, what happens is now we have a section 29A into place where the current promoters and the management people cannot take back the company because of the various issues that we know of. In pre-pack, we will always see that those management people would be the first one to jump the bandwagon. Now here we have 29A in IBC, and here if we just open pre-pack in the sense which is open in the foreign countries like Germany, Singapore being the latest one, like we have it in France, UK and US, and even in Netherlands, where the existing management is allowed to take back the company. Okay. So I think government is really now, it has opened up a discussion paper also, and the Graham committee has also come up with a report saying that these things really need to be looked into because a lot of preferential and undervalued transactions may have taken place. And if pre-pack is just done in the way it is done abroad, that may open up a lot of issues. So let me also tell you, in Singapore, a lot of now governance standards has been set where those issues are being plugged abroad also. Having said so, I think 230 in itself, I've always said in NCLT also that why 230 is only looked upon at the stage of liquidation. Why can't 230 also be looked upon as a viable option at the stage of CIRP itself? Okay, and I leave 2-3 thoughts with the participants and all of you is that pre-pack otherwise is a great option to look at because the cost will be too less. You all know that CIRP has got a huge cost in itself to undergo, and the time taken is less. And as Ajay sir was also mentioning in one of his question answers, that the stigma that gets attached with a company in CIRP is humongous. No supplier, no purchaser wants to get attached with a company which is in CIRP, and pre-pack will keep everything under covers, and it will happen privately. It's a private negotiation that takes place. Apart from many other things, I think getting the creditors on the field to approve a pre-pack is a Herculean task. So I think the promoters get into this pre-pack arrangement long back. They are into it for 1 year, 1.5 years, and then they come to the forefront with a pre-pack arrangement. So the promoters have to be very sure that they are not giving huge haircuts. In pre-pack, I think 90% of the loan is being repaid, and because you don't need to repay it, maybe in 5 years you get about 10 years time. So pre-packs, otherwise I think it's a great option to look at. Just the country have to tweak certain issues and maybe learn from our neighbors and the other developed economies of the world.
Yeah, and PS on this, if you permit me, I'll just supplement what Mamta is saying. I think she very rightly said, but this is what I was also advocating. It is that there is a RBI circular, there is a section 230, and even I think I had a discussion where they were saying that government might tweak section 10 of IBC to allow the pre-pack as part of that IBC. I think we can think about what I started with this was that why not we can think about a combo based on the facts and circumstances where we can use a combo of the provisions of the Companies Act, provision of IBC or the RBI circular in one way or the other, that we can very well think about it, that how best we can make a resolution plan outside the IBC.
I think the point, NPS, that is coming out from what Mamta said is you need to build adequate legislative safeguards against unscrupulous promoters. If you really want to make it successful, I think that's the way forward.
Right, sir.
Right. Satvinder sir, I have a question for you. It's a very interesting question. Can an LLP be merged into a company?
Oh, I think Chennai bench, we discussed this issue, Sahib, also earlier before. Though Chennai bench had, applying the principle of, omissus, casus omissus, they had approved it. But NCLT has rejected that on that appeal when they had gone into this. On the basis of this, was that they said that okay, now that you can't apply this principle everywhere for this. Here, under the Companies Act, there is no provision for that LLP to be converted into, to be merged with the company directly. So what he said is that, okay, since 366 allow you to convert LLP into a company, that is a better way that you first convert it into a company and then go for an amalgamation. So there may be the tax consequences arising.
When you convert the LLP into the company, don't forget us. There will be tax implications at that stage.
This is where I'm just making it is, there is a possibility that again, that might have been a tax planning, that they were converting LLP directly into a, merging LLP directly into a company. And obviously there would have been a tax issues. Otherwise they would have converted LLP into a company and then gone for the merger. But I think appellate authority, NCLT has very wide said that, okay, when the legislature has provided the conversion norm under section 366, you follow that and then go for amalgamation.
I think all that I am saying, united we stand, divided we fall.
Absolutely, Ajay sir, there is no doubt. In fact, that's how we have already agreed with your suggestion that we can't forget stamp duty and tax also. So tax to we first of all come and seek your blessings. Satvinder sir, I have received another question. Mamta ma'am touched upon about the foreign scenario for mergers. We have received this question, and in fact, I remember, Satvinder sir, if you remember, we did a scheme where we merged a foreign company based in BVI, British Virgin Islands, 10 years back for a renowned group, at least more than a decade probably, and we merged it before Allahabad High Court, and you and I went to argue on our own, and we explained it at least for 2-3 hearings, the judge, that it is permissible to merge at that time a foreign company into an Indian company, but the vice versa earlier was not allowed because of the provisions of section 394, which always said that the transferee company had to be an Indian company. But now the scenario has changed, so that's how the question has come. Can a business undertaking of an Indian company be demerged into a foreign company?
No, I think since you highlighted that matter where we argued it in the Allahabad High Court, NPS, that was, I think, again, it was one of a wonderful tax planning, I must say. And that was where Mr. Vora also pitched in that. And we took the view, opinion from Mr. Vora also, where the overseas company had sold that business and the cash, had it been there, it would have been taxed here. And we got that BVI company merged with the Indian entity. See, there was under, if you look at it, section 394 of the 1956 Act, they were saying that transfer company can be a body corporate, but the transferee company can be a Indian company. So that was in the as well 1956 Act. So we were saying the foreign companies are body corporate. But now what is happening is that now the issue where that's one of the issue, I would say the similar thing happened in the Sun Pharmaceutical. Now the Hyderabad bench earlier, now what is, I'll just take you, because under the 234 it talks about the cross-border mergers. Under 234 now they say that, okay, if the foreign company can be merged with the Indian company can also be merged with the foreign company, but there are two instances. One, that you have to take the approval from the RBI, number one, and secondly, that the foreign company should be into a notified jurisdiction, and that circular is already there, what all notified jurisdictions are. I'm not into dwelling into this. Now, similarly, in that Sun Pharmaceutical, in one matter, there was a demerger of the foreign company into the Sun Pharmaceutical. That was allowed. Now, taking that, okay, they probably had gone it that why not one of the investment business of one of the Indian companies getting demerged into a foreign company. Now, there the department ministry said that no, 234 talks about only the merger and amalgamation, and since it is a demerger, in the draft report there was a concept of demerger, and now you are taking it. To my mind, I think one could have taken it. The similar thing is when you are saying that provisions of this chapter is mutes mutandis applicable to this under 234. There is a same provision for 233 merger and amalgamation is taken it. So probably they would have extended that provision through the demerger, but somehow that argument which has been taken, but now the law is that NCLT that if there is a demerger of a foreign company coming into the Indian company, that will not be allowed. But today I would say that demerger of the Indian company undertaking into, the demerger of the foreign company into Indian company, that has been allowed. That is the precedent we have now.
I think NPS as a functionary of the Institute of Company Secretary, my suggestion to you would be, since this cross-border mergers have been allowed, the income tax law has not kept pace with these developments. So we really look at the amalgamated company being an Indian company. So if there's a merger of an Indian company with a foreign company, the tax neutrality is not there under the income tax law. Maybe you should make a representation to the government to bring it on par.
Very good suggestion, sir. Sure.
Mr. Vora, I have a question.
Yes, you must note
Yeah.
that. And with the help of Satvinder ji and Ajay sir, you must do this.
Certainly.
Chapa, that's your job.
So Sarah has given one
Mr.
more
Vora,
job to you. Yes.
Thank you. My pleasure.
So I have a question for you, Mr. Vora. So it's with respect to an amalgamation scheme. So the question is that in amalgamation as a form of consideration, can the amalgamated company issue debentures and bonds along with shares? And will issuance of debentures and bonds will take away the exemption provided in the hands of shareholders under the Income Tax Act?
So, Saib, I think the condition precedent is that 75% of shareholders of the amalgamating company should also become shareholders of the amalgamated company. That's so far as Section 21B of the Income Tax Act goes. So it will qualify as a tax neutral demerger. But the question is that when the shareholder receives bonds and debentures or cash along with shares, now whether he enjoys the exemption in terms of Section 47, I think 47(6), if I'm not wrong, that in lieu of shares held in the amalgamating company is receiving this bundle of consideration, shares of the amalgamated company, bonds and cash. There is an old judgment from the Karnataka High Court in the case of Master Raghuvi Trust, which said that amalgamation really does not amount to transfer. And therefore, there should be no tax incidence in the hands of the shareholder. But there is contrary view also available. So I think the predominant view is that if you get this bundle of consideration in lieu of your holding shares in the amalgamating company, you may be subjected to tax as the shareholder. But the amalgamated company or the amalgamating company will continue to enjoy the tax neutrality.
I think if I recollect, sir, the Chennai bench had of the ITAT had taken a different view out of this.
Yeah, I said contrary view is available, yes.
No, but
Yeah,
sir,
Rohit.
that judgment of the Chennai tribunal, when we'll have to revisit that judgment, because now there is section 56 to 10, as Mr. Vora rightly pointed out. Section 47 specifically talks of the consideration being received in the form of shares. So if I were to argue that I have received consideration in form of shares, apart from shares I have received something else, then what is that additional amount, additional security for? And if I were to say that is not consideration for amalgamation, then there is a chance of 56 to 10 also getting attracted. So I think one will have to be very careful in conceptualizing any such scheme, which involves, apart from shares, some other assets also to be given to the shareholders.
I think again, we will come back to the objective. So if the objective is actually to reward the shares of the amalgamating company shareholders with some cash, then in that situation, I think you will have to bear the incidence of tax. At least the cash will come home.
Right.
Right.
Rohit sir, I have another question for you. In fact, this is the same question which we were discussing a few days back. Are there any tax implications in case buyback of shares at less than fair value taxable?
No, if you see the under the provisions of the Act, the buyback is covered by Section 115 QA, and the tax incidence has been shifted in the hands of the company. So whenever a company buys back the share, they have to pay tax at the rate of 20% of the consideration minus the amount which they received originally towards the subscription of the shares. Now, it sometimes is contended that if there is a buyback which happens and buyback happens at less than the fair value, then in that situation there are some implications of Section 56. I actually don't see where the implications would arise, because when there is a specific Section 115 QA specifically dealing with the taxation of that kind of a buyback, so there is no question of 56 to 10 being applicable. Secondly, 56 to 10 applies when you receive any property, and in case of a buyback, what company receives its own shares. So I think one can reasonably contend that in view of specific provision of 56 to 10 and in view of specific provision of 115 QA, the 56 to 10 should not apply, irrespective of whether the buyback is at fair value or less than fair value?
No, I think
That's very Sorry, Ajay,
NPS,
sorry.
I'm just making it is just to extend this buyback and reduction. I'm just handling one matter. I think you are also involved, where we have to buy out the one shareholder, and that litigation was going on for years. And NCLT said that okay, you can you buy them, buy the 25% or buy the company. So the direction is that company has to buy back. No, buyback in the sense they have to put it. So we were just deliberating whether we can go ahead with the reduction or the buyback, where we are saying it because there are different tax implications for that part, because they said the company has to purchase the shares and cancel it. And I'm not eligible to buy the shares under the buyback regulations.
No, but if
Right.
this is a mandate of the court, then I think it will override the provision of the Companies Act. If the court says that in terms of this arrangement between the two set of shareholders, that the company will buy back the shares, the company has to implement the direction of the court.
So, sir, the problem here is the ROCs. So we are just wanting to have a clarification, because for making that reduction, the ROCs might not consider it.
No, for making the buyback, if this is the direction of the court in order to settle the dispute, I think you should go back to the court and say that, notwithstanding that it does not strictly fall in terms of the relevant section of the 213 Act relating to buyback, the court will make the necessary directions. They will override.
This is precisely what we are doing. Is we have already moved an application for clarification. Yeah.
Mr. Singh, I have a question for you. Is it possible to file a scheme of arrangement with record date being the appointed date and appointed date being the effective date?
I think if you recall, we have done a couple of cases, and that again the objective. See, what happens is that I'll just give you, if that question is coming by someone, probably he should have taken it that what is the intent behind it. But if I can understand, I'll give you my experience that we were doing it, the investment deal in a company where the investor is coming, but they were saying that, okay, we will not value the shares, value one business, you hive it off. They are coming it, that's the understanding is that I will divest that business, but in that process, what is they are already becoming a shareholder, it may take time. So we took it to that aspect that, okay, as far as the resulting company is concerned, resulting company will issue shares to the shareholders who were shareholders as on the appointed date. By that time, the investment had not come. If I will make that record date prospectively, probably they are also equally entitled to the shares. So concept is there, and to my mind, the record date can be fixed as the appointed date. And we got that scheme approved also.
I think, Sahib, if I can come in, I think on a more conceptual level, I would like to say that, this amalgamation is an arrangement, as you mentioned, arrangement between the shareholders and the creditors. Now, the court does not sit in judgment over the agreement between the creditors and the shareholders. The court only acts if it is against public interest. Now, if you have provided that, the record date will be the appointed date as also the effective date, I don't see any issue of the court interference unless there is a subterfuge in the arrangement. Right. And as Satvinder gave you the example of that other company, that the appointed date or the effective date would be the date on which you receive the last approval. Now, that is having regard to the facts obtaining in a particular case. There is complete flexibility so far as this is concerned. I think on a more conceptual level, I thought I need to address this.
Mamta ma'am, since we are short of time, we'll have to think how many questions we can take more, but I leave it to the panelists to guide us. But still, I'll take 2-3 questions at least. Mamta ma'am, one question, if you remember, I discussed with you, same question has come up by someone, that in 230 now NCLAT, जैसे Mukhopadhyay passed one judgment that even in case of liquidation under IBC, so now regulation 32 of liquidation regulation specifically provides for liquidation and sale of corporate debtor as a going concern. In fact, we have handled a matter which are very rare in the country as of now, where we buy the entire corporate debtor along with identified assets and liabilities as a going concern. But as per Justice Mukhopadhyay, in that judgment, they have said that every liquidator, and you being insolvency professional yourself, how many schemes you have handled in liquidation where you have attempted under 230 to get the company in liquidation sale as a going concern?
Let me point out that Sumit Pinani, who happens to be my spouse, he is the one who his case was the one which was instrumental to get in the fact of selling the company as a going concern. If you recollect the case name, it's Gujarat NRE Coke. It is a much talked about case in the entire country and now even abroad, where Justice VP Singh, when he was heading the bench of Kolkata, he had passed that order that the corporate at that point in time should be sold as a going concern. When this order had come, I remember there was a lot of hullabaloo and there was a lot of talks going on that how can a company in liquidation be sold as a going concern. But from that, IBBI and the lawmakers picked it up, and then we saw the entrance of even Section 230 by way of 2B, and now Regulation 32A in the liquidation process regulations, where a company can be sold as a going concern. Now, you rightly pointed out the judgment of Vaish Shivram Prasad. I think that is what you were pointing out. And of course, S.C. Shekharan, how can you forget that? Why those two judgments? The NCLAT said that before even wanting to sell the company as a going concern or sell the business of the company as a going concern, you ought to first try and bring in a scheme of Section 230 under the Companies Act 2013. So the honorable judge got in a mixture of the Companies Act along with IBC, and it went on to say that both these applications could be merged in one application and brought before the same adjudicating authority, where the said adjudicating authority will exercise two powers, one under the Companies Act by approving the scheme under Section 230, and another by way of sitting as a judge in the case of insolvency and the bankruptcy code, where it will be measuring that whether this case is most apt to be sold by a scheme under Section 230. Having said so, let me say what it is all about very quickly. It of course, as we discussed in the pre-pack time also, it is all about that a bunch of shareholders come together, or a bunch of creditors coming together, or even for that matter a liquidator, saying that we find value in this company and we would like to propose a scheme of Section 230. Now, there's a lot of deliberations going on that whether the liquidator needs to actually invite a scheme of 230 or not, or just a person can say that, hey, hello, I vouch to give a scheme of 230. In my opinion, even if the liquidator is not inviting a scheme for 230, it is in the act that it can actually go forward and give a scheme under Section 230. Why are we looking at 230? And do you think it should match with the liquidation value is another cause of concern which people have been talking. And I know time is running, so I'll just cut it short. That in 230, the best advantage is that I think that you do not need to really match with the liquidation value. Okay, what the creditors or what the lawmakers or what the adjudicating authority will see, that whether my employees are well placed or not, whether my company will go on or not, whether I will keep on adding economic value to the nation or not, and whether it will keep on contributing to the GDP growth of the nation. So if my employment is secured and if everything, the machineries keep on going, all the other incidentals will just happen. So 230 will be seen more as a revival of a dying corporate rather than as a recovery mechanism. And therefore 230, I think, has really evolved as a center stage, if not in CIRP, but in liquidation.
NPS,
more so,
can I come in for a moment?
Yeah.
Since you are not paying me any fees, let me also seek free advice here. So my question to Mamta is, you mentioned that you can have a combination of IBC and Section 230 of the Companies Act. Now, which will be the governing law in this case?
So while the 230 will be approved, the process will be all governed by the Companies Act. Unless the court says that this particular group of creditors, you don't need to have a meeting. Just for an example's sake, because there'll be a groups of creditors will be formed. Now, if, for example, the NCLT says, okay, this group, you may not like to do a meeting. In that particular case, the court order will prevail, but otherwise the process will be driven highly and perfectly by the Companies Act 2013. But the objective, Ajay sir, will be governed by IBC.
So therefore, if I re-articulate what you just mentioned, I would
Right.
tend to take the view that you have come to a decision under IBC that the company is ripe for liquidation, right? That there is no revival, there is no suitor for the company.
Right.
Now, having come to that conclusion, now you are seeking to extract maximum value, the liquidation value for this unit. And one of the processes is to sell it as a going concern or sell the business as a going concern. While you may follow the procedure process under the Companies Act, it will necessarily be under the IBC. So if you, and why I'm raising this point, suppose you have to write off the GST dues of this split. I think it will be governed by IBC and not under 230.
Absolutely.
So
Absolutely, absolutely right, Mr. Vora. In fact, I remember when we drafted the resolution plan on behalf of Patanjali for Ruchi Soya. I remember I was stationed in Mumbai for many days and we were drafting the scheme. So we included the scheme of, we drafted the plan and we included the scheme of amalgamation and arrangement as part of the plan itself as an annexure. And then also we discussed and evaluated the same question as to whether that procedure will be followed or it can be exempted. Time is less. I'm unable to deliberate more on it. Rohit sir, we have one more question for you, and then we'll have to leave rest of the questions. As of now, we'll certainly answer these questions probably by way of a separate mail or by way of a call to all the participants who have raised questions, because it's already 1:06 and we were supposed to close at 1. So Rohit sir, this two questions I'll quickly raise to Rohit sir directly. Both are directly related to income tax. One, Rohit sir, that in case of an amalgamation, appointed date is futuristic date. So how can one do valuation on futuristic date? This is one. And second, that in case of voluntary liquidation, because this voluntary liquidation I personally feel would be taken up and there will be a lot of consolidation of entities in the going forward time because of the recession which is expected, and also because of the downfall, many companies would automatically go for voluntary liquidation. So what is the tax implication, particularly the dividend distribution tax in case of voluntary liquidation?
No, in case of voluntary distribution, basically there is a specific section which says that in case of a distribution of assets, to the extent of the profits, it is treated as dividend in the hands of the shareholders, and the excess amount to the where there is no profits, that is treated as consideration and it is treated as taxable as capital gains in the hands of the shareholders. That is the first aspect. Insofar as your first question is concerned, that when there is a futuristic date which is given, and then how do we value the shares? I think we will have to give a formula over there that the valuation will have to be done based on whatever is ultimately the date, because you cannot define the valuation on a particular date. It's a contingent date, it's a date dependent upon various approvals. So I think that will have to be taken into consideration.
I think NPS, I would think that why can't you use the DCF? You
Yes.
use the discounted cash flow, you look at future earnings. So you are looking at future earnings, notwithstanding that the appointed date is in the future. You can use a DCF method for the valuation.
Which is internationally accepted methodology, even in FEMA purposes. So I feel we'll have to put an end now. Otherwise, we can take more questions, but it's already, and people must have scheduled their timing accordingly. So thank you all for overwhelming response. There are so many participants who have raised questions. We'll certainly answer. Satvinderji has already mentioned that 19th of May, we'll have another webinar on stamp duty, as we say, Ram Ram, Vaheguru, Vaheguru. And I'm sure the kind of exposure which stamp duty matters have, almost all participants of this webinar will also join in that. So thank you, Mamta ma'am. We have the chairman of and the president of MCCI with us, Mr. Gupta. I'm really not sure whether he's logged in at the moment. He's give us his blessings. Mamta ma'am, if you can, on behalf of MCCI, take it forward, ma'am.
Thank you so much. Thanks for that honor, NPS. It came as a surprise to me, but I'm very grateful for that. Ajay sir, Satvinder ji, Rohit ji, and of course, I cannot forget Sahib. Sahib has just done immense work to put everything in place. Sahib, thanks a ton. NPS, I think before I get on to others, I can't forget you, because you are always, if I may say so loosely or colloquially, you've been the darling of the show always. Wherever you go, you just steal the show. And today also you are that stealer here. It's such a pleasure to always get engaged with you and, you know, to be in such forums. Thanks a ton, NPS. You've got much task ahead to do, and being a council member, I'm sure you're very much cognizant of those liabilities and assets that you have. Ajay sir, for you, if I may say, I always say this for Satwinder ji, but today I'll shift the bandwagon and put it on you. And you know, there was this guy who was a great painter. I mean, he used to love paintings, and he used to love seeing people who make paintings. And once, you know, he was in Poland. Now nobody is going to go to London also. Satwinder ji has put a London photograph behind him. And somebody was mentioning that, Satwinder ji, don't take us to London. We want to be in India and in our homes quarantined well. So Ajay sir, what happened once that this Satwinder ji went to Poland for a holiday. And there in a park, you know, Satwinder ji saw a beautiful lady drawing some sketches. Satwinder ji could not resist and desist himself. So he went inside the park to look at that lady who was drawing those beautiful paintings. Of course, so he was quite amazed to look at that. He saw that she was drawing paintings with a sketch, with a pencil, you know, and doing very good work. So he said that, hey, beautiful lady, would you draw a beautiful sketch of mine? So of course the lady said, wait for your turn, Mr. Singh, Mr. Indian, we'll do it for you. So Satwinder ji was very happy to learn that. And just in a while, you know, his turn came and he cleaned the bench and sat in that bench to just wait for the lady to start her sketch. In just about 3 minutes, that lady finished the sketch and gave the sketch to Satwinder ji. Satwinder ji was amazed. Wow, in 3 minutes flat, a perfect sketch of mine. But his amazement was just to last for a few seconds. Just then the lady said, 300 pounds. My God, Satwinder ji said, for that 3 minutes, you are charging me 300 pounds. Have you gone berserk? The lady said. And here is where I want the attention of my participants and Ajay sir also. So the lady said that, hey, Mr. Singh, hey, Mr. Indian, this 300 pounds is not for that 3 minutes of my efforts, but it is for that 30 years of experience that I have put in to draw your sketch in flat 3 minutes. So that is Ajay sir. You know, he brought his humongous experience in front of us. And it's all our pleasure that Satwinder ji could actually ask your benign presence in this forum. We are really delighted. Thank you, Satwinder ji, for all that support that you extend to me always. You are a real brother, if I may say so. Me and you have not been born from a single family, but our extended family is really the same. Thank you so much for being there all the time. Rohit sir, it was amazing. It was amazing. I've never heard you before. And that doesn't mean that we were underpinning or undermanning your caliber, but the clarity and the thought process that you brought it out, I think a lot of participants have already been sending messages that it was a great panel. We've got a lot of clarity, and the best part of this panel was that we just spoke what it was. We never made a cover of words, and we were not very wordy, if I may call so. So I think this panel will be long remembered.
There was no arrangement. There was no arrangement.
Thank you
so
so
much
much.
on behalf of
Just on a lighter
Yes,
side, I
please.
also have an issue. You just said Sumit happens to be your husband. I was saying whether it was a choice or he just happened to be your husband.
That was a matter of arrangement. That was a matter of arrangement.
That was
And
Thank
no
you so much.
compromise.
Thank
No
you.
compromise.
No compromise.
Thank you
Bye,
on
Joy.
behalf of
Thank you. Thank you all the participants. Thank you,
all the participants also.
Thank you.
Thank you. Thanks, Sahib.
Thank you, ma'am. Thank you, ma'am.
Thank you.